Hi there, thanks for joining us here at PhillipCapital Market Watch. I'm Alvin Teo, Equities Dealer at Phillip Investor Centre, Toa Payoh branch. In this episode, I will be sharing with you why the US Federal Reserve is raising their interest rate. During the March 2022 Fed meeting, the Fed approved a 25 basis point, also known as a 0.25 percentage point rate hike on its Fed funds rate, resulting in its current rate to be raised from 0.25 to 0.5 percentage point. This is their first rate hike in over 3 years. The previous rate hike was in December 2018. Based on the chart, the Fed funds rate was around 2 percentage point in 2019. However, due to the COVID-19 pandemic, the Fed decided to reduce its Fed funds rate to near zero to prevent a potential recession. Many will question, what and how does the Fed funds rate affect the economy? I will be elaborating more on this in the next 2 slides. The Fed fund rate is the interest rate that financial institutions in the US borrow and lend their excess reserves overnight. As stated by the law, US banks must maintain a percentage of their deposits in an account with the Fed, known as the required reserve ratio. This is to prevent a bank run from occurring. A bank run occurs when a significant number of clients simultaneously withdraw their money from the banks, affecting their liquidity rate. The required reserve ratio is calculated based on the end-of-day balances in the bank's account, averaged over a 2-week reserve maintenance period. If a bank finds that it has more than what is required, it can lend its excess to banks that expect a shortfall in balances, earning interest from the loan. This interbank lending interest rate is based on the Fed funds rate. When the Fed raises its interest rate, it influences the prime lending rate that the banks charge their borrowers. Prime rates are the prevailing interest rates that banks charge their customers. As the Fed rate increases, the prime lending rates move in tandem with the increase. This increase also affects consumers' interest rates for bank loans, credit card loans, and adjustable rate mortgages. This ripple effect of interest rate increases as the borrowing of excess fund increases. Banks incur a higher cost to borrow to maintain the required reserve ratio. The banks then pass this increased cost on to its consumers, resulting in a rise in prime lending rates. Prime lending rates set the benchmark for interest rates of loans. Customers who do not have the best creditworthiness will face a higher interest rate than the prime lending rate. Inflation is the rate of increase in prices over a given period of time. Consumer Price Index, or CPI in short, is used as an indicator for inflation. CPI is a measure that takes the weighted average of prices of a basket of goods and services which consumers require for their day-to-day life. In January 2022, the US CPI rose to a 40-year high of 7.5%, which means that the US faces high inflation as the overall cost of living has been increasing drastically. Inflation is necessary for economic growth as it helps to increase consumption and consumer demand, which eventually increases the GDP of an economy. The estimated benchmark of inflation for a developed nation is around 2%. Anything above this could damage the economy, affecting livelihoods of its population. With the inflation rate at 7.5%, the Fed is under pressure to curb the sharp rise to prevent the economy from experiencing turmoil. This inflation rate in the US in recent years prior to the COVID-19 pandemic was around 2%. However, in 2020, the COVID-19 pandemic ravaged the global economy, affecting businesses badly. Therefore, the Fed decided to drop its interest rate to a range of 0% to 0.25% and launch quantitative easing as a form of emergency relief. As the Fed funds rate dropped, the interest rate for bank loans will also drop. This means that the cost of borrowing for consumers, which includes businesses, will drop as well. When businesses are able to borrow money at a lower cost, businesses will be encouraged to expand and grow. When businesses expand, there will be an increase in demand for labor, resulting in a fall in unemployment rates. The unemployment rate at the start of COVID-19 pandemic was around 15%. This significantly reduced to around 4% in the late 2021. The resulting effect of an unsustainable unemployment rate that is lower than its natural rate is unhealthy for the economy. This can be seen from the Phillips curve above, where the rate of unemployment is inversely related to the inflation rate of the economy. A lower rate of unemployment leads to a higher rate of inflation. Therefore, to keep inflation rate at a steady 2%, the unemployment rate in an economy should be around 6%. Any value lower than that will result in an unsustainable economy for a developed nation. The rise in inflation rate due to an unsustainable decrease in unemployment can be seen from these 2 reasons. cost push inflation, and demand pull inflation. As businesses expand, owing to an increase in investments, more workers are being hired to keep up with the growth, reducing the unemployment rate of the economy. To attract and sustain workers, companies would have to raise wages. This significantly affects the profit margins of firms given selling price stays constant. Therefore, firms pass on this additional cost to their consumers via an increase in price, resulting in a cost push inflation. In addition, as the economy grows, the disposable income of its population increases. With the increased purchasing power, the demand for goods and services will follow suit. This mismatch in demand and supply causes the prices of goods and services to increase till demand starts to fall. This is the effect of demand pull inflation. Firstly, let us talk about investments. As mentioned previously, an increase in the Fed funds rate will eventually lead to an increase in the interest rate for loans. Firms now will be deterred from taking too much loan. Therefore, firms tend to cut back on expansion, leading to a decrease in investments, in turn decreasing their demand for manpower. Next up, consumption. As the demand for manpower falls, the unemployment rate rises. Wages will decrease as labor demand decreases. This in turn results in a fall in purchasing power, hence a decline in consumption of goods and services, especially luxury items. As mentioned in the previous slide, interest rates have an inverse impact on both consumption and investment. Based on the GDP formula, where GDP is the sum of all consumption, investments, government spending, and net exports, an increase in interest rate will lead to an overall decrease in the GDP of an economy as both consumption and investment drops. Therefore, this will reduce the GDP growth rate in the US back to sustainable levels that will result in a healthy inflation rate. That's all for today's Market Watch. Do remember to like and follow us on social media or subscribe to us on YouTube. Thank you for joining us and see you soon.